Welcome to CEO Money. I'm Michael Yorba. Thanks for joining with us. I have Danielle DiMartino Booth. She is the CEO of Quill Intelligence on the show with me today. All right. Welcome to the show. Thanks for being here.
Great to be here today.
Now, you've been on our show before, but now you're in our new studios. Give our audience, our new audience, some background of where you come from, how you worked with Mr.
Sure.
Fisher, and I wanted to get into what your thoughts are on the economy, where it is, where you think it's going, and what are the potholes that we need to watch.
So I, like Richard Fisher, who was at the Dallas Fed for a decade, we both started on Wall Street. That's where we both started our careers. We were both MBAs in finance. After I relocated to Dallas, he discovered my writing and asked me to come advise him at the Fed. I never thought that I would work inside of a gigantic bureaucracy like the Federal Reserve. But I felt like I was answering my country's calling, so off I went, where I ended up advising him for the better part of 9 years throughout the financial crisis. So it was a very exciting time to be there. After I left, I wrote a book about the Fed and what I felt were its failings, and that went to 22 worldwide on Amazon, and I've been...
Not this one, you mean?
That one, Fed Up.
Okay.
Indeed. And ever since then, I've been writing a newsletter. I give speeches worldwide, and people follow my markets intelligence and economic research. I'm a cult.
Yes, you are. All right, and I'm a big fan.
Thank you.
So I'm really excited that you're here. All right. How do you see the lay of the land? What are some of the things that are happening, whether it's politics or economics, that you see that we need to know about and we need to be prepared for?
Well, I think what most Americans need to realize about the economy right now is how very influenced it is by politics. President Trump has been he's been very critical of the Federal Reserve, and the Federal Reserve, on the other hand, has also been fairly astonished at how violent the stock market declined in the last quarter of 2018, kind of the Christmas Eve bloodbath, if you will. And the about face that the Fed did after that has effectively bought this economic expansion more time. The economy was sliding into a recession. Most of the executives around the nation were anticipating that we would be in recession by 2019. And we've effectively pushed that out by a year's time. But we still definitely see signs that the economy is beginning to slow in some of our most cyclical industries. Housing, I think housing might get a little bit of a boost because mortgage rates have come down, but we're seeing definite weakening in the manufacturing sector, especially in the automobile and auto parts sectors.
Tell me about the pullback in the housing. Do you see that as a continuing process? Because I've had some people say, hey, we've topped, we've got maybe 15, 20 years of a declining market in that area. Do you see that same scenario? Or different?
I think that it's going to be dependent upon the markets. But that being said, demographics is going to play a bigger role in the housing market than it's ever played in any of our memories. When we went into the financial crisis in 07, 08, the baby boomers were able to sit back and say, you know what, I'm going to stay in the workforce for 10 more years, and I'm going to stay in my home for 10 more years. So there was effectively this mass delay by what was then the largest generation in America. They delayed selling their homes. And so the supply never came onto the market. In this next recession, baby boomers will be forced to sell to try and tap into that source of home equity, and they're going to be met by millennials who in many ways cannot afford to buy their homes. So it's this disconnect, this demographic disconnect, that I think is going to weigh on housing for a very long time.
Okay, so you're in agreement with some of the people I talked to. I get it.
Yes.
What about the manufacturing? You brought that up. I want to hear your thoughts about that, because there are certain sectors of manufacturing that may not fall into the pit.
There are. The problem with manufacturing in general is that the Trump administration has been playing a game of chicken with China, and this trade war rhetoric got to be so loud that by the end of the year, we had companies that were panic buying. They were trying to build up their stockpiles ahead of what they thought was going to be the implementation of higher tariffs. That didn't happen. So now we're seeing the unwind of that, and it is very dramatic. I mean, we're seeing big rig prices crash. We're seeing transportation stocks come down. We're seeing companies like Alcoa disappoint as well when they're earning. And again, the automobile sector, which has been so crucial. All of these things are unwinding what we call an artificial supply build. And I'd be interested to see which sectors of manufacturing can come out on top of this, given how broad-based the expansion was in manufacturing, again, to get in front of tariffs that never were.
Right. Do you see that as a strong bargaining chip, that what's going on right now? Because he'll bring it out and pull it back, bring it out, pull it back.
He does, and I think investors are becoming somewhat immune to all of the trade war and banging the drum, because it's been drawn out for every time there's an announcement. It seems like we've bought 30 more days of time. So at some point we become immune. What's much more important, I think, to investors, though, is the near $800 billion in stimulus the Chinese authorities pumped into their economy in the first 3 months of 2019, and the fact that we're seeing the fruits of that forced stimulus begin to play out in a rebound in Chinese economic data, which is giving hope that there's going to be a similar rebound here in our economic data.
You don't think that's a dead cat bounce over there in China?
Well, the problem with what the Chinese have done is that they're going to have to keep doing it.
Yeah.
So it's almost like your textbook Ponzi scheme. You know, the effects of rising stimulus can continue to bear fruit as long as there's more stimulus on top of the stimulus.
Right.
And their debt to GDP is already at 300%. So they're playing a very dangerous game right now, but the world buys into it because everybody wants for the stock market to go up, and we all enjoy that, and you have to have the liquidity in order to support that.
What about taxation? The rules that have changed. I've talked to some enrolled agents about this, and they're under the impression, of course, they're fundamentalists. I'm really a technician, but they're under the impression that because of the changing of these tax rules, that we've got a long takeoff period where we could actually have continued prosperity because of the fundamental changes made in the tax code. How do you see that?
You know, it's interesting you bring that up, because in the most recent University of Michigan Consumer Sentiment Report, they asked a very granular question from the time the tax bill passed through March. And the mentions of the benefits of the tax cut have literally disappeared. They've disappeared. And you're talking about corporate America and how it has benefited from the tax cuts.
Well, middle class seems to have benefited too, but go ahead, please.
They have, but by the same token, unfortunately, so many Americans, H&R Block conducted a survey, and 80% of Americans who they surveyed said that they had not changed the withholding to adjust for the changes in the withholding tables. So a lot of working class Americans who depend on that tax refund didn't get it and were budgeting for it. Right or wrong. Don't get me wrong. Their paychecks still increased in 2018. It's not that they didn't feel the benefit of the tax cut. It's that they just thought they were having a bigger income level and had not anticipated that they also wouldn't get the refunds. And we know that they're down 4% year over year. We know that over 1 million Americans who got refunds last year didn't get them. And we know that our economy keys off of consumption. 2/3 of the U.S. economy is consumption. What's going to happen if we don't get a bounce back in retail sales? If we don't get a bounce back in auto sales, are we going to see continued production cuts? Their auto production was down 13% in the first quarter. If that continues, there are going to be some more manufacturing jobs that are very high paying that get lost.
In some people's minds, it's a zero-sum game. So if it's losing here, it's got to be winning somewhere else. Do you see any pockets of prosperity that people should think about for their portfolios going forward?
Well, I think that people really do. I'm going to go back to demographics for a moment, because one of the most underserved cohorts is seniors who are going to truly be downsizing. They're going to finally be getting out of those McMansions. They don't want to have the maintenance of a home in their budget anymore. They'll truly be living off fixed income, and they don't have enough housing. So I speak to real estate developers all the time, and they see this as being a tremendous opportunity. Huge profits to be made in this massive wave of 70 million plus Americans many of whom are going to want to downsize. And there are opportunities. I look at the biggest opportunities as being underneath these Class B and Class C malls that are dying. They're typically in great areas of metros where I think not just millennials, but I think also seniors are going to want to be. They're going to want to be close to the hospital. They're going to want to be close to healthcare systems. So
Right.
I think that is a great way to play what's to come demographically in this country.
Talk to me about the natural resource industry, because that is the lifeblood. So goes copper, so goes the economy. I want to hear what your thoughts are on basics like that.
So, in the industrial metals complex, because we're seeing exports pick up in China, because we're seeing manufacturing pick up in China, copper is one example. I think China consumes a third of all the world's copper. I mean, these figures are so hard to wrap your head around in terms of what a large consumer they are. And we're seeing major bounce backs in some of these industrial metals that imply that we are going to have this resurgence in growth globally, driven by the Chinese export machine.
So
But again,
I'm getting the feeling it's a smooth run forward with a couple of bumps. I'm not getting a disaster feeling from
I
you.
wouldn't say disaster, but again, if success depends upon never stopping the printing presses, what does that tell you about underlying fundamental strength in the global economy?
So then we bring in all of the disruptive currencies that we're talking about, where everybody's trying to get away
Turkey's
from it.
melting, Argentina's melting.
Right.
There's so much dependence on dollar-denominated debt, especially among corporations. So there are a lot of countries that cannot afford. This sounds perverse, but there are a lot of countries that cannot afford for the United States to strengthen that much, because then the dollar will get too strong, and all of this debt that is held in dollar denominations is going to be impossible to refinance.
So Rothschilds buy while the blood is in the street is really going to come to pass here in some of these countries. Let me change
Absolutely.
course for a second. You are a noted expert on the Fed, all right? That means that you've got real good feelings, let alone analytical background, on where you think interest rates and what the policy might look like going forward. That has a big influence on what happens on everything else. What are your thoughts there?
Well, the bond market has begun to price in rate cuts going out into next year. And obviously the administration has been very vocal in calling for rate cuts. Where it gets a little dicey is we are headed into an election year. So I think that the Federal Reserve officials will be remiss about appearing to try and sway the direction of the election one way or another.
Of course.
And that actually tells me that they might be compelled, and you're starting to hear this from some of the officials, to do an insurance rate cut ahead of a material slowdown in U.S. growth, in order to start to get out in front of the political optics of it. Because if there's one thing that Jay Powell is not, it's political. But I would say that the direction interest rates are headed, according to market pricing, which the Fed has never defied, is down.
Beautiful. Thank you for being a guest on today's show.
Delighted to be here. Thank you.
Mine too. You've been watching CEO Money with Michael Yorba. Thanks for joining us. Like us on Facebook, follow us on Twitter, and subscribe to our YouTube channel. That was a great interview. I love the conversation.